Well, hello there, my sleepy friends. Tonight, we're going to wander through the quiet history of one of the most powerful and least understood institutions in the United States, the Federal Reserve. A name that sounds steady, official, almost inevitable. But the Federal Reserve was not inevitable. It was created out of panic, out of fear, out of repeated financial collapses, bank runs, frozen credit, and the uneasy realization that the country had become too large, too industrial, and too financially tangled to keep relying on older, looser systems of banking. And yet, from the beginning, people disagreed about whether creating a central bank would solve America's problems or simply create new ones. So tonight, as the lights dim and the world grows quiet, let's go back to the long years before the Fed existed, back to a United States that had money, banks, debt, and ambition, but no true modern central bank. To understand why the Federal Reserve was created, we have to begin with a recurring pattern in early American history, the pattern of financial panic. Again and again, during the 19th century, the American economy lurched between expansion and collapse. Boom, speculation, easy credit, then fear, then contraction, then bank failures, then unemployment, then a long, uneasy recovery. The United States had banks, of course. It had state banks, national banks, private financiers, clearinghouses, and a growing web of credit relationships. But it did not have a stable, flexible central authority ready to act as a lender of last resort when panic set in. And that absence mattered, because banking systems do not only fail when they are insolvent, they can also fail when people become afraid. If enough depositors rush to withdraw their money at once, even a bank with decent long-term assets can collapse under the immediate pressure. Banking, in a strange way, rests on confidence, and confidence is often quiet until it breaks. Throughout the 19th century, the United States experienced major financial panics, including those of 1819, 1837, 1857, 1873, and 1893. Each panic left behind the same unsettling question: who exactly was supposed to stabilize the system when fear took over? For a long time, the answer was messy. Sometimes private actors stepped in. Sometimes clearinghouses improvised emergency measures. Sometimes governments did very little. And sometimes the country simply endured the pain. This was not because Americans were indifferent. It was because they were divided. The United States had a long and suspicious relationship with central banking. There had been earlier national banks, the First Bank of the United States and the Second Bank of the United States, but both were politically controversial. To supporters, a national bank could help stabilize finance, improve credit conditions, and bring order to an unruly monetary system. To critics, it looked like concentrated financial power, too distant, too elite, too intertwined with political interests, too capable of favoring some regions or classes over others. Andrew Jackson's war against the Second Bank in the 1830s left a lasting cultural mark. For many Americans, especially in the decades that followed, suspicion of central banking became part of the national political instinct. And so the United States entered the late 19th century as a growing industrial giant with a fragmented banking system and no permanent central bank. This arrangement worked until it didn't, and when it failed, it often failed dramatically. As railroads spread, cities expanded, corporations grew larger, and financial markets became more interconnected. The weaknesses of the old system became harder to ignore. The economy was modernizing rapidly. The banking framework was not. Money could be scarce when it was needed most. Seasonal demand for cash, especially around harvest time, could strain the system. Banks were subject to legal and structural limits that made them less flexible than they might otherwise have been. And because reserves were unevenly distributed, pressure in one part of the financial system could spread quickly. What America had was not chaos exactly, but it was something brittle, a structure that could look acceptable in ordinary times and suddenly look dangerous in extraordinary ones. And then came the Panic of 1907. This is the event that sits, like a low bell tone, beneath the creation of the Federal Reserve. In 1907, a financial panic shook the United States after a failed attempt to corner the stock of United Copper Company helped trigger broader fear. Trust companies came under pressure, the stock market fell, and panic spread through New York's financial system and beyond. In the absence of a central bank, the response depended heavily on private intervention, most famously from J.P. Morgan, who helped coordinate support for endangered institutions. There is something almost cinematic about this moment. A private banker in a crisis gathering other financiers into rooms late at night, reviewing balance sheets, deciding who might be saved, who might not, and how to contain the panic. It was dramatic. It was effective to a point, and it was also unsettling because it suggested that in moments of national financial emergency, the country was relying not on a public institution with a formal mandate, but on the prestige, judgment, and coordination of one extremely powerful private man. That was not a comforting long-term solution. The Panic of 1907 convinced many policymakers that the country needed something more systematic, not just emergency heroics, not just improvisation, a structure, a reserve system, a mechanism that could provide liquidity in crises and reduce the risk of collapse spreading unchecked. After the panic, Congress created the National Monetary Commission to study banking reform. Lawmakers, economists, and financial leaders looked closely at banking systems in Europe, where central banks played a larger stabilizing role. But even then, the idea of an American central bank had to be handled carefully. The word itself carried political danger. Too many Americans feared Wall Street domination. Too many feared federal overreach. Too many feared that a central institution would become either a servant of private finance or a tool of centralized political power. So when reformers moved toward a new system, they had to build something that looked, and in some ways truly was, more decentralized than the great European central banks. And this is how we arrive at one of the most distinctive features of the Federal Reserve. It was designed as a compromise, not purely public, not purely private, not fully centralized, not fully regional. The structure reflected America's distrust of concentrated power almost as much as its desire for financial stability. In 1913, after years of debate, Congress passed the Federal Reserve Act, and President Woodrow Wilson signed it into law. The United States finally had a new central banking system, or rather, something close to one, because the Federal Reserve was not created as a single towering institution in the way many people imagine. It was created as a system. Regional Federal Reserve banks would be established around the country, with a governing board in Washington. This was deliberate. The designers wanted a balance between national oversight and regional representation. They wanted bankers involved, but not fully in charge. They wanted public legitimacy, but also technical competence. They wanted elasticity in the money supply, stronger reserve management, and a way to respond to panics. At its core, the new system was meant to solve a few recurring problems, to furnish a more elastic currency, to improve supervision and reserve coordination, and to provide a lender of last resort function in times of stress. That sounds tidy. In practice, of course, institutions are never quite as tidy as the laws that create them. The Federal Reserve began operating in 1914, and almost immediately, history accelerated. That same year, World War I began in Europe. The new institution was still young, still learning its own structure, still finding its footing, and already the global financial environment was shifting around it. Wars have a way of enlarging state institutions. They demand financing, coordination, bond issuance, monetary adaptation, and broader administrative capacity. The Federal Reserve's early years unfolded under these conditions, and the institution's role expanded faster than its founders may have imagined. Still, the early Fed was not yet the modern central bank we think of today. Its policy tools, internal culture, and understanding of macroeconomic management were still developing. And like many institutions, it would be shaped not just by its founding mission, but by the crises that tested it. The greatest of those tests came in the 1930s. The Great Depression remains one of the defining chapters in Federal Reserve history. It is also one of the most painful. After the stock market crash of 1929, the American economy spiraled into catastrophe. Banks failed in waves, credit contracted, prices fell, output collapsed, unemployment soared, and the Federal Reserve, in the view of many later historians and economists, failed to respond adequately. This criticism became especially famous through the work of Milton Friedman and Anna Schwartz, who argued that the Fed allowed the money supply to shrink disastrously, worsening the depression rather than cushioning it. That interpretation became deeply influential. Even among people who differ on details, there is broad agreement that the Fed's actions in the early 1930s were gravely insufficient relative to the scale of the collapse. Why did this happen? Partly because the institution was still relatively young, partly because central banking theory was less developed than it is now, partly because officials were constrained by gold standard thinking, institutional fragmentation, and uncertainty about what should be done, and partly because in moments of historic collapse, people often do too little before they understand the size of the danger. The Depression changed the Federal Reserve forever, not only because it exposed weaknesses, but because it shifted expectations. After the 1930s, Americans were less willing to accept a hands-off approach to financial catastrophe. The federal government's role in the economy expanded, bank regulation increased, deposit insurance arrived, and the Fed became, over time, more firmly embedded in a larger architecture of national economic management. The lesson was harsh, but lasting. If the banking system collapses and the money supply implodes, the damage can spread everywhere. And once society learns that lesson, it rarely forgets it. Then came another global war. World War II again transformed the relationship between the Federal Reserve and the federal government. During the war, the Fed supported the Treasury's financing needs by helping maintain low interest rates on government debt. This was part of a broader wartime arrangement, and it reflected a familiar pattern. In extraordinary national emergencies, central banks often become more closely tied to fiscal demands. The immediate priority was not abstract monetary purity, it was winning the war. After the war, however, tensions emerged over whether the Fed should remain subordinate to Treasury financing needs or reclaim greater independence in pursuing monetary stability. This issue came to a head with the Treasury-Fed Accord of 1951, a milestone that is often treated as the beginning of the modern era of Federal Reserve independence. The idea of central bank independence can sound a little strange at first. After all, the Federal Reserve was created by Congress. Its leaders are appointed through political processes. It is not some floating institution detached from public life. And yet, independence in this context means a degree of insulation from short-term political pressure, especially pressure to keep money easy or rates low for immediate convenience. The basic argument for independence is simple. Politicians often have strong incentives to pursue short-term growth, cheap borrowing, or pre-election economic comfort, even if those choices create inflation or instability later. A central bank that can say no is supposed to help resist that temptation. Of course, critics see the same arrangement and draw a different conclusion. They ask why so much power over credit, interest rates, and financial conditions should sit with unelected officials. This tension is permanent, and it sits at the heart of the Fed's history. In the decades after World War II, the Federal Reserve became more recognizable in its modern role. It influenced interest rates. It shaped credit conditions. It tried, with varying success, to balance employment, growth, price stability, and financial calm. Over time, its mandate came to be understood in terms of what people now often call the dual mandate: maximum employment and stable prices. Simple words, difficult balance, too much restraint, and the economy may weaken unnecessarily. Too much stimulus and inflation may build, respond too slowly to bubbles, and risk instability later. Respond too aggressively and risk causing the very downturn you hope to avoid. Central banking is often described as technical, and in many ways it is. But at its core, it is also deeply human. It is the management of uncertainty, the art of acting under incomplete information, while millions of people make decisions that no committee can fully predict. And nowhere did this become more obvious than in the 1970s. The 1970s were a hard decade for the Federal Reserve's reputation. Inflation rose sharply. The old post-war assumptions seemed less reliable. The United States faced oil shocks, fiscal strain, slower growth, and a difficult mix of inflation and economic weakness, often called stagflation. This combination was especially troubling because it challenged the comforting idea that policymakers could reliably trade a bit more inflation for a bit less unemployment. Reality was rougher than that. By the end of the decade, the credibility of the Federal Reserve had been badly strained. If a central bank cannot preserve the purchasing power of money, people begin to doubt not just its policy choices, but its purpose. And so, in 1979, Paul Volcker became chair of the Federal Reserve. What followed was one of the most famous and painful anti-inflation campaigns in American history. The Fed pushed interest rates very high. The goal was to break inflationary expectations and restore confidence in price stability. It worked, but the cost was severe. The economy endured a brutal recession. Unemployment rose sharply. Factories closed. Communities suffered. Volcker became, depending on who was speaking, either the stern savior of the dollar or the cold administrator of unnecessary pain. In truth, he was part of the same tragic logic that appears again and again in monetary history. When inflation becomes deeply embedded, restoring credibility can require measures that hurt real people in the short run. That is one reason central banking so often feels morally uncomfortable. It is never only about numbers. After Volcker came Alan Greenspan, who chaired the Fed from 1987 to 2006. For many years, Greenspan was treated almost like an oracle of economic management. Inflation was lower. Growth was relatively steady. The economy seemed more stable than in earlier decades, and the Fed's reputation rose with it. This period was sometimes described as part of the Great Moderation, a stretch of reduced volatility in inflation and output that encouraged confidence in central banking. But confidence can become its own hazard. Periods of calm sometimes hide accumulating risks, and by the early 2000s, those risks were building in housing finance, leverage, and the broader financial system. Then came 2008. The financial crisis of 2008 was, in many ways, the Federal Reserve's defining challenge since the Great Depression. Major institutions came under pressure. Credit markets seized up. Panic spread through the financial system. The risk was not merely that some firms would fail, but that the system itself could freeze. And here the Fed responded far more aggressively than it had in the early 1930s. It cut rates sharply, created emergency lending facilities, worked alongside other agencies and institutions to stabilize markets, and later, under Ben Bernanke, it pursued large-scale asset purchases, often referred to as quantitative easing. To supporters, these actions helped prevent a far worse collapse. To critics, they looked like bailouts for powerful financial institutions, a rescue that stabilized Wall Street while leaving ordinary people to bear the long aftermath. Both views contain part of the truth. The Fed did act to prevent systemic collapse, and many people did feel, not irrationally, that the financial system was protected more quickly than households were restored. The crisis deepened public attention to the Federal Reserve in a new way. It was no longer just a distant institution adjusting rates in the background. It had become visible, and once power becomes visible, scrutiny intensifies. In the years that followed, the Fed remained central to debates over recovery, inequality, inflation, asset prices, labor markets, and the limits of monetary policy. Then, during the COVID-19 pandemic, it again intervened on a massive scale as economic life suddenly froze and financial panic threatened to spread. Rates fell, facilities opened, balance sheets expanded, emergency support moved quickly. The modern Fed had become, in effect, a crisis manager of extraordinary reach. And this returns us to the deepest question in its history. What is the Federal Reserve supposed to be? A neutral stabilizer? A lender of last resort? A guardian against inflation? A steward of employment? A protector of financial markets, a technocratic institution standing above politics, or a powerful actor whose choices are inevitably political, whether it admits that or not. The truth is that the Federal Reserve has been all of these things in different proportions at different times, and that is why it remains controversial. Its defenders say that modern economies need a central bank. Without one, financial panics can spiral, liquidity can vanish, and recessions can become depressions. Its critics say concentrated monetary power is dangerous, that the Fed distorts markets, socializes risk, rewards leverage, enables government borrowing, or claims a kind of technical neutrality that hides profoundly political decisions. These arguments are not new. They echo the fears that were present at its birth. Fear of panic on one side, fear of concentrated power on the other. The Fed was created in the space between those two fears, and it still lives there. If we step back and look at the whole story, the shape of it becomes clearer. The Federal Reserve was born because the old banking system was too fragile. It grew because crisis kept expanding the demands placed upon it. It was criticized for doing too little in the Depression, then shaped into a stronger modern institution through war, reform, and changing economic theory. It fought inflation in the 1970s and early 1980s with painful force. It gained prestige in calmer decades, then became a crisis firefighter again in 2008 and 2020. At every stage, it accumulated not just tools, but expectations. And expectations are a form of burden. Once a society comes to believe that its central bank should prevent collapse, stabilize prices, support employment, calm markets, and preserve confidence, the institution becomes something larger than its founders imagined. Not omnipotent, but central, quietly central. Like plumbing, you only notice when it breaks. Like a foundation, you only think about when the house shakes. And perhaps that is why the Federal Reserve can feel both obscure and strangely intimate. Most people do not follow its meetings closely. Most people do not read its balance sheet. Most people do not spend evenings thinking about reserve requirements or open market operations. And yet the Fed's decisions reach into mortgages, job markets, business loans, savings accounts, pensions, inflation, and the broad emotional weather of the economy. A rate cut can feel abstract in Washington and very real in a kitchen. A tightening cycle can sound technical on television and deeply personal in a town losing jobs. This, too, is part of its history. The Federal Reserve is not only an institution of economists and bankers. It is an institution whose choices ripple outward into ordinary life. And so, tonight, if we imagine the history of the Fed as a series of quiet rooms, we might see it like this: a 19th century bank trembling under the pressure of withdrawals, a group of financiers in 1907 reading ledgers by lamplight, lawmakers arguing over how much power should be centralized and how much dispersed, a new reserve system opening its doors just as the world tips into war, Depression-era officials watching failure spread faster than their confidence, post-war planners debating independence, Volcker holding the line against inflation at immense human cost, traders in 2008 staring at screens as markets seize, and through it all, the same old problem returning in new forms. How do you build a monetary system that is flexible enough to survive panic without making it so discretionary that people no longer trust the restraint of those in charge. That is the Fed's central puzzle. Not one it has solved once and for all, one it keeps inheriting. As we close, it helps to remember that institutions like the Federal Reserve are born from contradiction. People want stability, but they also want freedom. They want money to hold its value, but they also want credit to be available. They want rescue in crisis, but they dislike concentrated power. They want expertise, but they distrust elites. They want someone to act when panic spreads, but they worry about what that actor becomes over time. The Federal Reserve exists because these desires do not easily fit together. Its history is the history of trying to hold them in balance, sometimes wisely, sometimes clumsily, sometimes too timidly, sometimes too boldly. It was created to make panic less devastating. It was reshaped by depression, tested by war, humbled by inflation, expanded by crisis, and watched, always, by a public that needs it and doubts it in almost equal measure. That may be the most enduring part of its story. Not that it inspires trust, not that it inspires suspicion, but that it inspires both. And perhaps that is unavoidable for any institution given power over something as strange and sensitive as money. Because money is never just economics. It is confidence, memory, promise, fear, and the Federal Reserve sits at the center of all of them, quietly adjusting levers in the dark, while the rest of the country sleeps, borrows, saves, spends, worries, hopes, and wakes into whatever economy comes next. And tonight, from a distance, that long history softens a little. The panic rooms fall silent, the ledgers close, the marble buildings go still, the trading floors dim, and the story of the Federal Reserve becomes what all history becomes, eventually. A record of people trying to create order in a world that never stays ordered for long. Sleep well,